Good evening, everyone. I'm Gary Kirshner with the UDT SEAL Association. I'm the association's communications director. Welcome again to another seminar on financial wellness. Tonight, we're going to be talking about using your home equity for short term, which basically means you need to know how to use it wisely. So let's just say if you make poor choices here, things could go bad really fast. Well, maybe not really fast, but it will put you in a predicament. So I'm sure Michelle will explain, how not to do that. Take it away.
Wonderful. Thanks as always, Gary. And hello, everybody. Great to be with you again. And as Gary mentioned, kind of what we're going to be talking about this evening is this thing called your equity that you have in your house, that home equity, and when you might want to tap into it, how you build it, where it even comes from. And then as Gary mentioned, ensuring that when you are tapping into it, that you're thinking both short and long term financial goals and decisions as you make kind of that decision on which way you want to go. So with that, I'm going to start sharing my screen real quick. So let me make sure that the technology is playing nice this morning or this evening. Thumbs up. Perfect. Okay, guys. So as we mentioned tonight, we really are talking about this thing called your home equity. And as we hop into this, just as a really quick reminder, this is the 10th time you guys are catching our seminars, or if it happens to be your first. I am Michelle Crumley, and I'm your host this evening. I do have 30 years experience as a military spouse and with this community, actually. And then also 20 years in the industry. And it was this community of ours that really helped launch what I wanted to do, how I wanted to do it, and being able to provide education to our military and veteran communities about finance and education and mortgage. And that's kind of how I've gotten into this crazy world that we are in. And then I've got with me as well, Mr. Ben. Remind us who you are. It's been a couple of weeks or a couple of months since we've had you with us.
A little bit. I enjoyed the break, but good to be back with you guys. A little bit about me. Well, I've been a lender for nearly 20 years. I get to creeping up on the 20. I realized that the other day, which is a little wild. We got the lending side down. Air Force is what brought me out here originally as a weapons loader on F-15s. I love connecting deeply with people and helping them through their finances as well. It's the best part of the job is taking people who need to get to a different place where they are financially, whether that includes home ownership or not. And happy to be here.
Wonderful. Well, and we know, and especially if you've been watching the market at all, right? Things can change very rapidly. Rates go up, rates go down, babies arrive, kids go off to college, time to upgrade the kitchen or your HVAC needs replaced. Maybe you need to look at moving your parents in. Maybe you need to look at taking care of some of your own health or long-term health planning. Or maybe you're just really looking to start planning for retirement. And did you know that your home, when planned for properly, can be a huge asset when you start looking at these different life changes and seasons that you go through, and how your house can be a huge part of that plan that you put in place. So, Ben, would you say that right now we are seeing a crazy market?
It's been volatile. It's been volatile. And the reason for that, if you guys didn't know, is that, we enjoyed nearly 2 years of quantitative easing where the Fed and the government was nice enough to keep mortgage-backed securities at a stable level position because they were going to buy them every month and all of that. And then they basically decided to pull out of that in hopes that the economy was recovering and we were moving ahead post-COVID. And then all of that brought forth all the buzzwords we're sick to death of in the news right now about inflation and everything else. So there's a lot going on. So rates right now are trending a lot more with world events than they were for a couple of years. So.
Yep. Well, and I would say one of the the silver lining over the last couple of years with all of this is that we have seen a lot of home appreciation. The value of your home has been going up. And that's really what we are going to be talking about this evening, which is as we think about your home and the home's investment, really thinking through what is this thing called equity, home equity that I have? How did I earn this home equity? Where did it come from? How is it growing? We want to talk about when you might want to think about tapping into it and the pros and cons that come with that. Also, then, if you are looking at tapping into it, there are a number of different vehicles that you might use to do that. We'll talk about very, very briefly rate term, because that's really not pulling equity out. But we'll explain again to kind of give you a level set some of the vocabulary. But then we'll talk about a cash out refinance, what that kind of looks like. That second mortgage that you might hear about, which is really your home equity loan or home equity line, what they are, why they're considered a second mortgage, and then what's the difference between the loan and the line. We'll round that out with talking a little bit about reverse mortgages. We hear about them on television. Tom Selleck loves to tell us about them. And they actually do have, all mortgage products have a specific group, individuals that it really is a good loan for, but you got to understand it. So we're going to just provide some basic information on that, if that might be part of your retirement or long-term planning. Then we'll round that home with any questions that we have, and make sure that we're also set for November. So with that, so tell me, Ben, what is home equity?
At its core, home equity is the difference between what you owe on the house and what its value is in the marketplace, which is usually determined by an appraisal, which of course is a comparison of other homes that have sold in the last 6 months that are in the neighborhood, most ideally very similar age and quality, to get an idea of what that is. You know, we're not talking about selling your house, although if you do sell your house, then your equity is fully realized. You take that money out when you sell your house. If somebody is paying you more than what you owe on it, then that difference is your money, and that's the creation of equity. That is it. So the equity gets realized in a number of different ways, and usually through either sale is one main way. Of course, you could take, I don't know, let's just say you had a house and you bought it in 1980 for $37,000, and now it's worth $340,000. You know, though, if you sold it, that's all your money. You would hope it's paid off by now, of course, and then you can do whatever you want with that money. You know, go buy another house. Maybe you're moving in with your kids because they have a mother-in-law unit for you to move into or whatever. So yeah, lots of things there. So, but at its core, difference between what you owe.
Absolutely. And the way that you earn that, right? There's a number of different ways that this equity bucket in your home grows. And you may start, right? You may start when you buy your house, making a down payment, putting some of your own funds into there. So you owe less than what you actually bought the house for. So that's some instant equity that you have in your home's value when you're between what you owe and that value when you purchased it. You can grow your equity as well. Every month that you are making a house payment, you're paying down the principal that you have on that loan. So you own more of the house. You have more equity in that property from what it's ideally worth, right? And what you owe.
Yep.
You can also write through home improvements. You actually change, you buy a house that was built in the 1990s, or in Gary's situation in the 1890s, and you might need to do some updating, right? So when you do the updating, you do those home repairs, or you do the add-ons or the additions, you put in that gourmet kitchen, it adds value to the house, right? So then again, that value of the home, what you could sell it for on the market, ideally is going up.
Sorry, I was going to say, a lot of people with initial down payment, there's a perception when you're buying a house, especially for the first time, and the VA loan, of course, doesn't need down payment, but other loan types do. And so when you have a down payment there, some people perceive it as like a fee And it's not. You're not losing that money. You're just putting it into a non-liquid state in the house. So wanted to touch on that. On the principal and interest payments, yes, every payment even from payment one is kind of a forced savings plan. Portion of your mortgage payment is going to slice off and pay down on the principal, and then you only pay interest on the remaining principal. That's why we encourage everybody to pay extra towards the house when you can. And then I like the home repairs. I would have skipped that in my mind, I think, because I forget about that equity creation. So to understand how to get the most out of those dollars. I would highly encourage everybody listening to talk to your local real estate agents to see what is getting the most bang for the buck. Is it worth it to spend $70,000 on a pool in the backyard? Like, probably not. It's not going to add $70,000 of value to the house, but some things will be a direct worth. You put in a fence, or you get the kitchen right, or you update a bathroom, you might see a direct return on those dollars.
Yep. Well, and then the market that we've seen, right? This market that we've been in the last couple of years, we've seen market values, home values increase, right? So that's like the free money. That's like you didn't have to do anything but own the home and stay there long enough that you're seeing the value of what you bought increase. On the flip side, if you happen to have bought like in 2006, right before the market crashed in 2008, you might have lost a little bit of equity because the home values fell over time, right? If you follow that trajectory is up, but there are those market fluctuations. So keeping that in mind, because that can directly impact what your equity is. So I think, and Ben, you hit it on the nail. Like, so let's say that you bought a home for $250,000 and you used a VA. You used your VA and you borrowed $250,000. So at that point, on that day, you didn't have any equity, right? You owed exactly what that home was valued for, that purchase price. But now let's say you're a few years down the line, right? And you've paid that mortgage down to $200,000. So you paid $50,000 of principal in there, and the home's value has actually jumped from $250,000 when you bought it a few years ago to $400,000. So that difference between that $200,000 that you currently owe and that $400,000 that the home is worth is that equity, that $200,000. Now, it's great that you have it, but you don't actually get to put your hands on it unless you sell, and then you get the money, right? Or you have to borrow against it, right? You actually have to take out another loan or refinance the loan that you have to actually put your hands on that money. And we want to talk about why you might actually want to do that, right? This is not, right? And this is where, as Gary was saying too, you want to be really smart. You don't want to just go, oh, look, we've got some money sitting here in our house. Let's just pull it out and take a vacation. Or let's just pull it out and pay off all of our credit cards and turn around and run them right back up again, right? So you want to make sure that if you are going to use the equity in your home, that you're really thinking about it strategically, and you're doing things that are going to put yourself in a better financial position.
Yep.
So tell me a little bit about why we might want to access this, Ben.
Yeah. So, I mean, I'm glad you mentioned the getting into debt again problem. So when I got into the mortgage business in year Q, the trend of the day was that people were taking, and it was this run up, from 2003 to 06, where equity kept growing tremendously and the market value of the house went so far over, expectations, where people were just, paying and overpaying for houses. And so that rose up, that the people that already owned their house, that brought their value way up. Well, the other thing that was going on economically was that people were spending gangbusters amounts of money on anything else. It was just, debt became a problem. So there was a lot of people that were way over their head with credit cards, not realizing that they had a 27% interest rate. And so even making the minimum payments on those credit cards became an excruciating struggle. And The solution, I mean, I guess you could go through a bankruptcy, but I mean, Lord knows if you're in the military, getting a BK done and messing up your security clearance and being at risk of other influences when you're in bad debt, those are all bad things. So a lot of folks would tap into equity through a new loan or a full refinance and get that cash out and move the debt. They didn't get rid of the debt, they moved it. It's still there. And then they moved it into the house loan and then spread it out over another 30 years to freshen up, sometimes at a higher interest rate than what the rest of the house was at the time, which would be the case now for most folks. Like a lot of folks right now, they're in the really sweet spot for interest rates. You're in the 2 to maybe even as high as upper 3s right now for a lot of folks. And so similar things going on. The world is much more expensive. Inflation is an issue. We all know. We're feeling it at the pump. We're feeling it at the grocery store. And some people aren't adjusting their lifestyle for those expenses. They're not backing off of the frivolous things. And so they're going into more credit card debt. So I think we may see some of this come about, but it is not ideal, guys, because it's not a get out of jail free card. It's not a free money. I mean, even though the money was maybe created by market rising, and so it's kind of free money, but it's still debt you have to pay. And
you
so that's
borrow it, you pay it.
That's it. That's a big deal. So yes, is it a better vehicle for paying those down and being able to get on top of them eventually? Yes. However, once those credit cards are wiped out, you better change behavior.
Cut them up.
Yeah.
Do not reuse
Gotta
them.
change behavior. It's because I mean, what good does it do you if you go out and run up the cards again? All you've done is created, wiggled for much more debt, and now you really are going to need to file bankruptcy. So, never good things. Leading into home improvements, any investment into the home that makes sense and is good for the value of the home. So never a bad move. And I think that's especially true while you live there. There's so many people that hold off doing anything with their house until it comes time to sell. And then they want to spruce it up for the next person to enjoy.
Well, how many times on Love It or List It do you see them choose to stay in the house after they've done the updates, right? Instead of selling the house, they're like, oh, wow, I didn't know it could be this nice.
Sure.
They choose to stay versus selling. So making where you live wonderful, right? But at the same time, making sure that any updates or improvements that you're doing have that long-term positive effect to the value of
in long term. You got to think about what may work for the rest of the market. Like would it be cool to have a gold toilet and the gilded bathroom, and because that's your style and that's what you love? Like, sure, but is that going to appeal to everybody else that's going to come behind you to buy the house? Maybe not. So that's where there's some wisdom involved. And yes, we want to make our house ours, and that's true when we talk about the forever home. But I have had clients who thought they were buying the forever home and then 2 years later we're moving on to something else. So you got to be really, really sure that this is the last place we're buying. Things are very fluid with all of that. And that'll bring us to talking about the reverse mortgages and all that. So you want to talk about tuition?
Yep. We know that college tuition typically is something that goes up, not down. And we also know, especially for those of us that have kids that now may be looking at going to college or in college, one of the things that we have seen a lot is where families will use some of the equity in the home to help pay for the college tuition for their kids or even for themselves, right? Maybe they don't have, or they make too much money for the student loans that are out there, that this is something that they could use good interest rates, sometimes better than what you could do either in a personal loan or in an unsecured loan, something that you could look at there. I love the idea of that, building that financial portfolio, utilizing the equity that you have in your current home, some of it to use to buy that second home or your investment property, right? That's continuing to build that financial stability for yourself.
Yeah. Yeah, it's a good way to go. We're seeing a lot of that. I've seen things pick up quite a bit where people are, now that we have a world where there are short-term rentals that are working well for Airbnb or VRBO and all that. That can be a good creation of a second stream of income. So there's a lot of homework to be done if you're going to go down that road. And to talk, that's mostly a thought about investment property. I mean, if you're going to occupy something as a second home, in all honesty, that's great. If you happen to rent it out when you're just not there for half the year or whatever, then, cool. You can do that, of course, but you want to be genuine with how you're approaching what you're doing with that. But there are some great loan products out there to get into investing in property and then creating a situation where somebody else is paying that mortgage for you with whatever's going on with that, and to pay it down for you and create that. And then, obviously the leftover after expenses is a positive stream of income that you can create. So equity can be used for, I guess in truth, any investment. I have had people pull out cash out of their house and go right into the stock market. It's risky. I don't recommend it necessarily, but if money is money, so it's your money. That's the best part about America. We get to do what we want with our money. So that's it.
There's some really good advisors out there that will help you, and good, extremely great loan officers that understand the ins and outs of all of these, that can show you the pros and cons and the benefits and or the potential obstacles or challenges in making those decisions. So always be reaching out to your experts.
I managed 60 apartments in Norfolk for 4 years. It's property management is not all it's cracked up to be. So you can afford a good one to handle those nonsense things for you. It might be a part of your strategy, but again, a lot of homework to do if you go down that road.
And as we're getting a little older, and or our parents are getting a little older, you may need to be looking at long-term care options, and your house, your asset, your home can actually be a part of that plan. Maybe it's you need to update your bathroom, right? So that you've got a walk-in or roll-in shower. Maybe you need larger doorways. So one from the home improvement, or in that case, remodels for staying in your house longer or bringing your family into the house. But also then if you do have costs associated with some of that long-term care, your home's equity can be a one of the eggs in your basket when it comes to how to finance or how to pay for that. That makes sense.
Yeah, for sure. Yeah, it's we're going to see more of that, guys. We have definitely an aging population coming in. I promise you, you do not want the expense of just going to live in an assisted living facility if you can help it. It is outrageously expensive. So the longer you can stay in your own house and make that work for yourself, that is a quality investment in that. And if you're coming into your late 40s, 50s, 60s, anywhere in there, I think it's important to be cognizant of if that house is going to serve your needs. Should you have a mobilization problem where, if you're just not ambulatory to get in and out perfectly by yourself, how hard is it going to be to build a wheelchair ramp? Can you get around the house, or is it only 2 rooms you can get through? Because those are the only doorways that are going to fit that thing. So I think you got to have that in the back of your head a little bit for some of those plans and thinking about that. It's part of the reason why I bought my house, if I'm being honest. So, yeah.
You're over 40. Come on, Ben.
Just a little. Emergency stuff. Nobody plans for emergencies. And obviously tapping into the equity from a loan standpoint is not an immediate thing. Nobody can snap a finger and get you a bunch of cash out of your house. It's going to take 20, 30 days, if you're really pushing it to get the cash out. So that's why we always recommend, just from a financial wellness standpoint, good to have a cushion for those emergencies on a liquid cash basis. I highly recommend that for sure. If you got 6 months of living expenses that you can manage, that is a worthy financial goal to pursue. However, Some emergencies may be different. Maybe a hurricane comes through and throws a tree across your house, and this is maybe a point to with Ian going through in Florida and everything else, and we always have hurricanes every year. Your house, if you just have homeowners insurance, you don't have a flood policy, does not cover flood damage. So if you have a flood, and that could be you have a pipe burst while you're away for the weekend, and you come back and your house is flooded from a burst pipe, that your homeowner's insurance may not cover that, guys.
It'll fix the pipe.
Yeah, you might get that stuff handled, but all your drywall and baseboards and flooring that you got to replace, maybe not. And I would encourage everybody to also just as a point of this, because it is pertinent in the news right now, check your deductibles on what this stuff would cost you, because some of you out there, I guarantee, have 5% deductibles on your homeowner's policies. So something happens to the house where you do have an emergency, you have a fire, something happens, that's definitely a valid homeowner's insurance item, is if you have a fire. Well, if half the house is gone with that point, you may not be fully covered here. You gotta check that deductible, because if you don't have that 6 months living condition, 5% of your house, it's not
It can be a big chunk.
You're talking, 20, 30, 40, 50 grand. It could be a big piece, depending on how much your house is. So,
well, and when we talk about emergencies too, Ben, one of the things that I was thinking, and as we get into the home equity lines of credit, is if you are responsible with your funds and you don't think of it as a blank or endless checking account or credit card, you can always set up a home equity line that you have access to based on your equity, but not that you are physically using. And we'll talk about the home equity line in a little bit more detail, but kind of that forward thinking before there's an emergency, having that plan in place to be ready for if and when there is one. Right. So these, again, this is not an exhaustive list by any stretch of the imagination, but it's the ones I would say, Ben, that we see most often when it comes to people that are looking for or to access the equity that's in their home. Is there anything that you think we've missed here?
No, I mean, it's not exhaustive by any means, but we're not here to exhaust everybody either. So, there's a lot of reasons we all know to spend money on a million things, but you just be forward thinking and smart about the value you're getting for whatever spending you do and what you're getting. So, it circles us back to the debt picture. Keeping on top of that is, moving a lot of high interest debt into your house, while a good idea typically is a one-time sort of get out of jail free card. For what it's worth, you have to change behavior. So that's the biggest trouble I really see people get into is just mounting credit card bills and not being able to stay on top of it. And if a credit card is your emergency fund, you got to tighten up. So yeah, all right,
absolutely. So if we've decided, okay, we need or we want to, there is a very smart reason that we've decided to tap into our equity. Let's talk a little bit about the different ways to do that, right? So the first is a true regular, what we would consider mortgage refinance option. And you'll hear, right, that lingo. There's rate term refinances and then there's cash out refinances. What we're going to be primarily talking about tonight is the cash out, but just so that we've all leveled the playing field. So rate term really is when you're using a refinance just to take advantage of lower rates or better terms that are out there. You're not looking to access the cash. The only equity you might use is the equity to cover the costs of the refinance and roll it, because it really doesn't, it just allows you to roll it into the loan so that your loan amount's a little bit higher than it was, because it's got those fees now that you didn't physically pay. But that's really it. You're not tapping into your equity for other reasons. You're just refinancing for that better rate or those better terms.
Yeah. So if
that's that rate term.
You're dropping into a better rate, then you want to be obviously coming out of the other end with a lower mortgage payment. That's about improving cash flow on a monthly basis. So, but you do have to be wise to that. If you're moving in 6 months Do you want to do a rate term refi, even if the interest rate's like 5% lower than what you have? No. You're not going to recover that cost of the refi before you sell the house. So you would gut it out in that circumstance. So anytime you want to check about that, if you are thinking about making moves, and we do see interest rates drop, because they will eventually. It's part of the reason why they're probably going up, so we can lower them later. That's that we'll be here to talk about that. But that does lead us into the primary point of tapping into equity, and that is getting a cash out. So a mortgage refi cash out is going to replace the mortgage that you currently have on the loan in full. It's a whole new loan. It's a whole new underwrite. It's probably a whole new appraisal, maybe not. And we don't have to get into that nuance entirely. But the point of all of it is, and it's the same thing. I mean, the cost associated with that, we're giving you a check at closing. So you're not going to bring money for closing costs to this situation. You're just going to reduce how much cash you maybe get out. And a cash out mortgage is going to depend on what kind of loan you have, as far as how much equity we can tap into for that. So the VA loan used to be able to tap into 100% of the current appraised value if you wanted to. And not too long ago, was it maybe 2 years at this point at the most, like they basically, lenders as a whole and Fannie and Freddie decided that it was a little risky, and we're seeing some higher default rates. So when a vet was going in and let's say they've had a house for 10 years and suddenly they're tapping into every penny of equity that's in that house, sometimes if something happened to that person, and that, so then they were left holding the bag for way more than they thought. So they are going to control the amount of risk in that process. And you can still do 100%, but it's going to cost you a lot of extra in fees and interest rate. So they made it very unsexy to tap into anything over 90%. So they want to keep 10% cushion of equity in that new loan, basically. So what we're going to look at is the difference between the payoff on your mortgage, which is what you owe plus about a month worth of interest, basically. And then however much cash you're taking out is where you're setting that line, basically, versus, again, what you may owe or what the house is worth ultimately. So, you got to understand those numbers so that how much equity is remaining in the current marketplace, so that you know what to expect moving ahead. And a lot of the decisioning on cash out and whether to do it or not should revolve around how much longer you are likely to own this house.
Yeah.
So,
well, I think, Ben, going back to that example that we used, just talking about what equity was. So again, let's say that you bought your house at 250, you finance the whole thing, you're a few years down the line, you now only owe 200 because you've paid it down, the home's worth 400, and you want to access $100,000 for a bathroom and 2 bathrooms and a kitchen remodel.
Sure.
A cash out is going to take that 200,000 that you still owe. It's going to get rid of that old loan, right? So that $300,000 loan that you're going to do, it's going to pay off that $200,000 loan with this new one at $300,000, and you would walk away with that $100,000 of your equity to use in those upgrades that you wanted to do in that instance.
Right.
Leaving you still in that case $100,000 of untapped equity that's just sitting there, hopefully still growing, but that you haven't tapped out all of your equity by pulling out that $100,000 in that case. Yeah. So again, just thinking about it as a replacement of your current loan. So new terms, new rate, starting back at 30 years, or maybe it's a 15-year loan, but it is a brand new loan with new terms and new rate that's replacing the old loan. And then anything over what you owed on that old loan is coming to you or taking care of those debts that you're paying off.
Michelle, are you coming across any older population that actually accomplishes paying off their house these days and they have full equity?
Yes.
It happens. Still happens.
It does. It
not
does.
as often as I would like to
see. Their homes longer.
Yeah. Yeah, it's a nice thing to see. It's rare to come across somebody who has fully paid off a house, but it is, when you get down to that point in life, I mean, that's why we need if you're thinking about your planning and this overall picture of financial wellness, there's a day that's going to come where, you're going to quit working and you're going to have whatever you've built for yourself to rely on. And a part of that can be this asset.
Yep.
With that, and we'll touch into that here shortly. So
absolutely. So that's the cash out, right? Just the basic replacement of what you had with something new that's giving you some of that cash. Then we hear, right? We hear this second mortgage term a lot, right? Why do they call it a second mortgage, right? So this is that home equity loan or that home equity line of credit. And it's called a second mortgage because your first, that mortgage that you had, that $250,000 loan that you've paid down to $200,000, you still have that loan with the same terms that you've had. We're not touching that on a home equity loan or a home equity line of credit. This is truly what they call that second mortgage. It's a new financing that's coming in and going to be it's going to stand behind your existing mortgage. So you'll have two loans that your home is a collateral for. And this new one, usually it's the smaller of the two. This is the second mortgage, is standing in line behind that first mortgage that you took out on the property. It's that subordinate financing, which means which no one's ever going to have happen, but if you defaulted on the loan and ended up in foreclosure, that first mortgage that you had, that $250,000 loan you took out, will be the first creditor to be paid from the proceeds on that foreclosure from when they sell the house. And then that second mortgage is going to be paid out anything that's remaining in what was sold versus what was owed. So that's kind of why it's called that second mortgage.
It's in second lien position, basically. Yeah. It gets recorded at the courthouse after the other one.
Yep. Yeah. It's number two in line. It's not number one. But there are absolute times, and we are actually right now in one of them, that if you were looking at accessing your equity, you might choose to do a second mortgage versus a cash out refinance touching that first loan, right? Because you might have that 2.5% on that first mortgage, right? And you don't want, and it's the larger mortgage, right? Maybe you only need $50,000. Right. Maybe you only need $100,000, but you've got a $300,000 loan that's out there. You don't want to refinance that big bulk at a higher interest rate. So you would look at that second mortgage for that smaller amount that you need if those terms are not as beneficial to you as what you have on that first mortgage. Does that make sense? Would you explain that differently at all, Ben?
No, well, not necessarily differently, but the second mortgage and let's just tap into this a little bit. So right now, yes, like me, for example, I have a house that I bought at 2.25%, which is ridiculous. Probably the best we'll ever see in the world, right? Like I'm hesitant to let that go for any reason. So that helps me accomplish paying it down much faster with that lower interest rate, creating more equity more quickly, right? So I don't want, even if I needed to tap into 100,000 in equity in this house, I don't wish to take all of that debt that's still existing on the house and move it up into a much higher interest rate range just to tap into the cash.
Nope.
Okay. Now, does it make sense to a point? It depends on how much cash you're getting out and what you're accomplishing doing it. And that's especially true in a debt consolidation situation. However, regardless, it still is probably better to just do a home equity line of credit or a fixed rate home equity loan and the terms on those aren't going to be quite as sexy as that 2.25. Home equity lines of credit, for example, and most of these are tied to an interest rate that is going to fluctuate. So everybody that offers these has their own rules that they're writing, because these aren't normal qualified mortgage loans that are going off to Fannie Freddie where there's a universal set of rules. So every different credit union can offer different things. So like one of them locally recently was offering 2.99 and it was fixed for 3 years. That's not bad, and then whatever happens after 3 years, well, they'll tell you, it's going to be tied to probably the prime rate in the Wall Street Journal that's published. And it may be plus or minus a certain percentage point, depending upon your qualifications and credit, all of that. But it gives that person 3 years to go, okay, I accomplished the things I wanted to do. And maybe what happens, if they get to the end of that 3 years, if interest rates at the time are favorable, then it may make sense if they go to a not so great rate because it's been fixated at 3%, and they may move you over into something else. So my point to that is, at that time, maybe it will be worth looking at a cash out refi to consolidate those two loans into one that is then fixed and spread out over 30 years. So,
yep.
Michelle, what do you know about these, like sort of some of the repayment terms that might be different on these?
Yep. So let's break down the difference, right? Because you hear home equity loan or you hear a HELOC, that home equity line of credit, and there are some very significant differences between those two, right? When you talk about that home equity loan, so it's a second loan, right? Done usually through financing. But it is generally for a fixed rate for a fixed term. It may have a balloon, it may not, but it mimics very closely the general parameters of a first mortgage. It just happens to be the second mortgage. The interest rates are typically higher than you're going to find that you would see on a regular mortgage.
They're higher because there's more risk.
There is more risk, right?
To
This
the lender.
person is in second lien. If anything happens, they are much more likely not to get paid than that person that's in first lien. And the default rates, right? If you were doing a cash out, if you're pulling equity out of your home, the default rates on it versus just a standard purchase are higher. So that there's added risk involved in general. So you're going to see higher interest rates. They're typically still much lower than a personal loan or that signature loan or an unsecured loan that you might get.
And larger.
Yep, exactly.
Yeah.
And just as your regular mortgage, as you pay it down, it goes away, right? You can't reuse it as you pay it down. It's just like fixed rate, fixed term, you pay it down, it disappears until it's gone or you've paid it off. Yep. And it's gone, either of those. Anything that you'd add, Ben, on just that home equity loan?
No, just bear in mind they're going to be shorter term loans. Typically, you may see a 15-year, 10-year sometimes. I've seen as much as 20, but I don't know that I've seen a 30-year fixed rate second. Pretty rare stuff. You might catch those on a purchase. Like I've been doing some loans lately where it's a second home purchase, and the rates are far more favorable on at a 60% loan to value on the first, and then you get a second for 30%, and then you put down 10% to get to your 100. So we're seeing some of that, but yeah, that about covers what that loan looks like. Basically, you just got to really investigate those terms, and because they're not regulated and they are so different, make sure that you really dive into those terms. What are you agreeing
Read the fine print.
Yeah. Yeah.
You don't want to find out 3 years in you have a 5-year fixed balloon that at the end of 5 years, while the rate was fixed, you owe the whole thing.
Yeah,
right?
yeah. Balloon guys, and what they mean by is like, it's not just, you have to generate that giant chunk of cash, but they're just like, hey, we don't want the loan anymore, so go refi, go put that into something else probably. So that's what a balloon's all about. HELOCs, however, there we go. I love the wording. It's exactly what's going to come out of my mouth. It's like a credit card. It's just secured by the house. So you have a certain amount of time to utilize it. So you can open a line of credit and take nothing out. This is a great tool to have in your back pocket, where all you're doing is paying on the amount that you actually pull out as you see fit, just like a credit card. So There's, well, you mentioned the draw period there. There's, again, going to be various terms. Every lender on this is going to be different. Frequently, what I'll see is something like 10 years. You have 10 years of, borrow some money, pay some back, borrow a little bit more for a different project, pay it back down. You can flex that around and pay it up and pay it down the whole time during that 10 years. But at the end of that term, they're kind of like, all right, guys, you've had your fun. We want you to go ahead and start paying off whatever remaining balance there is, and we're done playing ball with this. Yep. And so then they're going to say, okay, well, the remaining balance is X, and there's a certain amount of time that we want that money to be collected. So let's say it's another 10 years, and they're going to factor out the payments at the interest rate on how much they're going to expect from you to get that knocked out in that 10-year time frame. Yep. So, and interest is usually variable. It's going to move around, guys. So that's where I definitely have had occasions, prior to the run up in 06, where there were people who did have home equity lines out there, and those rates were getting pretty gross. And so we would look at the whole picture of like, all right, well, your first mortgage is at 6%, and then your second mortgage is at 10%. So together, you're really paying, like, once you've figured out all, there's math, that you can do. It's a blended rate. Okay, cool. Well, you're in truth on all of the money borrow, you're paying an average of 8%. Let's just say in this example. So maybe a full cash out refi at 7.5% would be better. And that's where that can maybe make sense. So lines of credit can be a great tool to accomplish the things you want. And I love them for emergency funds. Gosh, I mean, I wish I had and we'll get there someday, but just anytime anybody gets a normal conventional loan, or they put a bunch of money down, or any loan, if you're rolling equity from the house that you sold in Colorado and you move here and you plunk it down on the new house, you have that instant equity. It'd be great to leave somebody with a HELOC, because it's a way to tap that, but they don't have to. It's just there. It's kind of like a savings account off to the side that you don't have to use, and you probably shouldn't unless you really need it, but good emergency fund.
Yep. And then that's where that whole being fiscally responsible becomes so important. If you have access, it doesn't mean that you should go use it. It just means it's there in case. Yep. Anything else before we move to kind of that reverse mortgage that you would want to cover on these vehicles that we've talked about?
Just from the whole wellness picture, there are some personal loans out there that aren't too terribly abusive. If you want to have a line of credit out there, but you don't want it necessarily tied to the house, or if you don't have enough equity in there for an emergency fund, those products do exist. Again, just tread lightly, really do your homework and read the terms and conditions, which is, something we always click accept, but we never read. And yes, in those cases, you really want to truly understand everything you're getting into. So,
and don't be afraid to ask questions. If you read something and it's talking about that it's fixed for this month for this amount, and this is what it's based off of, and this is the margin and how much ask questions until you completely understand. It is heartbreaking to see somebody get into a loan that they truly didn't understand, and it puts them in a worse position.
And that's going to be more rare these days. The disclosure requirements are actually quite huge these days. They've given as much protection as I think they can manage without bogging down lending as a whole. But it is why we had the 2008 housing crisis, is there were people who, the guidelines were too loose. People who shouldn't have gotten loans, got loans and didn't understand the terms, so that when those rates began to adjust, and they always adjust up, there was problems, and then affordability problems, truly, where we had a rage of bankruptcies and foreclosures. And, that's what brought that whole collapse in 08.
Well, and I think that we would be remiss if we didn't at least talk a little bit about, because the reverse mortgage does have a place for the right person, for the right reason in their financial plan. You hear it a lot talked about being used for those that are house rich but cash poor. And you hear that then really about, like, for our seniors that might be on that fixed income that we were talking about, that have still some debts that are out there, but their fixed income may or may not quite make it, or allowing them to have the the lifestyle that they wanted. A
Right.
reverse mortgage can be a very big part of a retirement plan, but you've got to understand it. And actually, when we get to the next slide, that actually talks about, you know, what all goes into qualifying for these, because it's very, very different. Your credit is not something that weighs at all, really, for the most part, in a reverse mortgage. But it's important that you understand it. And education is a requirement. You actually have to take a class on the reverse mortgage. And I would tell you, if you have heirs, if you have kids that are expecting to inherit your house and they think that, you know, they're going to inherit the entire value of it, you're going to want to make sure that they have been part of this discussion and the education as well.
Yeah.
And what that reverse allows you to do, it allows you either, again, in a lump sum or in kind of that line of credit, allows you to access the equity that you have in your home without having to make a payment while you live there.
Yep.
Okay. You don't actually pay this loan back. You're not required to. You might choose to, but you're not required to until you either move from the house, it's no longer your primary residence, you sell the house, or you pass away. At
I
which
think
point
in
then you have
pains,
to.
anybody listening that just hearing this is probably like, well, okay, cool, but like, what's in it for the lender? How do they make money in this? If they're not receiving payments, what do you mean? And I'll get ahead of that. It is very much, there's a lot of fees involved. They're going to take what they're going to take kind of upfront and a big chunk. So I know you have another slide coming that's going to explain this a little deeper, but
Yep.
that's the answer to that question. They're not there to take over your house. They don't, you know, they're not trying to just steal your house or kick you out or
You
anything.
stay the owner of the house. You just don't have to make payments while you're there. So how does that work? So going back to our example a minute ago, right? Let's say your home today is worth $400,000. And at the moment, you don't have a loan on it, or you have a very small loan. But let's just say you don't have a loan on it. And you're like, you know what? I want to access $275,000. I'm going to put it in a line of credit, and I'm going to draw on that every month to supplement my actual income.
Your Social Security, your retirement or whatever.
Yeah.
Yeah.
And
Mhm.
let's say that I'm there and for a period of 7 to 10 years, and I haven't made a payment. And I've been slowly using this $275,000. I may never use all of it, but let's say I go to sell the house. I'm moving into assisted living. The house, we're going to still say, is worth $400,000. It should be a lot worth more, but we're just going to easy numbers, still worth $400,000. I have had this loan, not made a payment, but interest has been accruing on the back end of that. So let's say that I've accrued $75,000 worth of interest over these 7 to 10 years that I had this loan. Okay. Now, instead of owing $275, which is what I originally borrowed, I now owe $350 when I go to sell, right? That's where that interest is getting paid back. You just haven't had to pay it. It's just been accumulating on the back end.
Yep.
So when you do sell, you owe the amount that you've used plus the accrued interest. Then anything over that is your equity.
Yeah.
Right.
And all the same things happen that would happen in any circumstance. So when you leave a house, you know, no matter how you leave the house, you know, they carry you out of there, or you go into assisted living, or you're just ready to move in with your kids, or you found something smaller, whatever happens, you're leaving. And let's just say it is the worst case scenario about a reverse, because mostly it's a senior product. You know, okay, they pass away. What happens? The same thing that would happen with any mortgage that was due on that house. It's got to be paid off.
Yep.
You know, the lender's going to, okay, cool. You're not here anymore. We haven't been receiving payments, and we're good with that. We know we have a different payoff than we would have had, just depending. Pay it off, you know, so the heirs can sell it. They can refinance it into their own name. Or honestly, if they wanted to, I mean, I guess it happens, you could walk away. I mean, you don't have to do anything with it. You could just let the bank foreclose on the balance and they'll sell it and all that. Why you would let that equity escape is beyond me, but
They didn't have a good advisor.
yeah, I mean, it's just, but it is an option. It doesn't have to be your problem as an heir. So there, it is a great asset and tool, but it is a little complex, and definitely a lot of myths surrounding this where there's issues, and the issues in the past that did happen with reverse mortgages is in the qualification process. There was no requirement to make sure that they could pay the taxes and insurance. So those things still have to be paid.
Yep.
The taxes and insurance. So there was people who were, getting their money out on a refi and doing that, but then they wouldn't pay that. So you quit paying taxes, Uncle Sam going to put a lien on the house, and then they're going to refi. They're going to foreclose. They're going to get that taxes paid. So that is an important feature if you end up having a family member or yourself go into a reverse, is you want to make sure you are set up to pay those things as time goes on. And I think we've heard affordability issues in some areas where someplace became maybe much more valuable. They bought it in some little neighborhood that was fine in the 50s and calm, cool, and collected or whatever, but now it's the super gentrified, up and coming, like worth a lot of money sort of place. So if the value of that house became very tremendous, the tax bill is also tremendous, and that can create an affordability problem from a cash flow basis for some seniors. So yeah.
So,
All right.
and this is very basic, right? There's a lot that goes into it. What this is to give you a little bit of a taste and an understanding of it, for you then to have conversations with your advisors if this is a product that might help you or one of your family members, right? Your parents, they may own a home, they may own it outright, and you're having to help supplement income. This is something that they could consider. Really, from a qualification standpoint, the biggest factor is you've got to be at least 62 years old. You have to be the owner of the home, and you've got to have a lot of equity in it already, right? So either a no mortgage or a low mortgage compared to what the value is. It has to be your primary residence, and it has to be a single family or a 2 to 4 unit home where you occupy one of the units. Can't be a condo or anything like that. No manufactured homes. From an income asset position, you're not credit qualifying, but you're going to have to show that there's no federal debt that you owe, and that you've got the financial resources to make sure that the house itself is taken care of. Property taxes, the insurance, maintenance, all of that's going to be still handled. Have to educate. You've got to go through a reverse mortgage class done by an approved HUD counselor. And then it's going to be a formula based on, if you're 62 versus 72. The life expectancy is a little bit different. If you'll be able to borrow more at 72, get more equity out of the house at 72, because you're not projected to live as long as the person that's trying to access that equity at 62. So
Right.
It's a formula based on your age, the value of the home, the market, and the interest rates that are out there that will then dictate how much you are allowed to borrow. Okay. But definitely something you're going to want to check with an advisor on, and you have to do some education on, but it is a potential solution or part of that plan.
Yeah. And for the counseling piece, like I would say it's mostly factually true in my experience that people who do reverse mortgages, it's all they do as far as mortgages. Everybody I've ever met that does reverse, it is absolutely their only thing that they do. It is a passion to serve seniors and to help them find solutions for their problems.
Yep.
Through all of that. And I've so we have, well, I know 2 that are amazing, at least here. So they're out there. It's not something I do. And I don't think it's something you do as well. So
you don't want someone to dabble in it. You want this
Yeah,
to
no.
be the thing they do. Yeah.
Yeah, it's a little different way of thinking and counseling and dealing with people that are a member of the family and concerned. Nobody wants an elderly person to go into these loans not understanding what's going on, which is why they created the educational requirement. So if this is something you're thinking about, would encourage the whole family to sit in on that class or do that counseling. with that person. So you really do get everybody's on the same page situation for asset management and planning.
Yep. And then guys, just to wrap us up, because we are at that hour mark, the key takeaway is really just making sure that you're using, if you decide to tap into equity, make sure that it's for a good reason. And it's things that are going to help your overall financial situation, your financial profile. Okay. There are lots of options. So talk to your financial advisors, your loan officers, make sure you're working with experts that have you at the center of what they are doing, show you the options, make sure you understand them and you're choosing the one that is best for you. And that accessing equity does come with its own issues as well, right? You've got closing costs that you're going to be having to pay, potential higher foreclosure risks. You've got someone else that's in line now if something happens and you go belly up. And it also lowers your current equity position that you have in the house because now it's tied that particular part of your equity up. So just recognizing those. You know how to reach us. Our email addresses are here. If you do have questions on any of this, let me stop sharing and pop back with you guys. And again, just thank you guys so much for being with us. Gary, I know that next month we're going to be talking all about parental assistance, long-term care, Medicare versus Medicaid, in-home versus assisted living. Got a wonderful care coordinator that's going to be with us, as well as I think Jenny and Mike will be back with us as well.
Oh,
I'm
awesome.
going to hand this back to you to bring us home tonight.
All right.
Thanks,
Thank
guys.
you very much. Thank you guys as always. This is great. Yeah.
I actually have a quick question.
What is it?
Yes.
Yes.
So I actually have a HELOC on my first home, and then we bought my second home, and we were doing the HELOC as like a safety net option as we were deciding to buy our next home. And the thing I was told about our HELOC, when I told my loan officer that I was looking at another home, she was like, la, 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 don't tell me that. We only do HELOCs on your primary or like the residence that you occupy. Is that common for most HELOCs where they'll only give you a HELOC on the home that you're actually living in, or will they give you HELOCs on investment properties?
It's a stacked risk because you don't live in the house. So their investment properties bring a much higher risk category to a lender because you don't live there. We value the roof over our head dramatically, right? So it's a very big deal for all of that. So if you know something happens to an investment property and you stack that with being in second position, it's not shocking to hear that that particular institution may not offer it. That doesn't mean there isn't an institution out there that won't. And that's, you know, that's a matter of homeworking to find. So I hope that answers your
Primary
question.
and your second home usually aren't too hard to find, but I would say going back to, it's not it's not nearly as regulated as that Fannie Freddie first mortgage is. So each institution will have its own risk tolerance. And then asking those questions, do you do seconds, home equity lines or loans? And what are those parameters on investment properties?
Tougher to find for sure.
Got it. Thank you guys very much. I appreciate it.
Great question, James. Sorry, I usually ask if there's questions and I just blew right by that one tonight.
James, thanks. Again, guys, thanks so much for kind of helping us navigate these complicated waters, shall we say. I mean,
Yeah.
I think once you begin to start peeling back the onion, you realize how complex all of this can be and what the options are, and really, you know, requiring everybody to think about what's right for them and doing your homework. So again, thank you very much, and look forward to next month. I'm sure it'll be a topic many of us have faced and will face. And so with that, I'm going to say goodnight. Take care, guys.
Thank you.
Thanks, everyone.
Got everybody?
I am stopping recording. Yes.
Cool. Thank you, ma'am.